As I may have mentioned in my last video, my videos moving forward will be a little more a la carte. Instead of one video covering an entire chapter's contents, I'll mostly make videos that cover individual topics within a chapter. Doing so will make better use of your time, as you can just look at the video's title to find the subject matter with which you need help, as opposed to searching through timestamps within a particular video. As for right now, we're going to begin merchandise inventory. I should note that I'll be covering the gross method for accounting for merchandise. If your instructor is teaching the net method, I'd suggest you view my alternative presentation on the subject. Generally speaking, there are three types of businesses. So far we've talked about the accounting for service companies. These are businesses that sell you their specialized labor or use of their specialized assets. Common examples include businesses like law firms, accounting firms, car rental, auto repair, lawn maintenance, or in the case of our previous example, Coats and Arms, the ever-booming movie prop and weaponry rental industry. The second type of business is manufacturers. These companies purchase inputs, be them raw materials or some other finished product, and then process or assemble those inputs into a new product. Auto manufacturers like BMW or Ford, food producers like General Mills, and cleaning product producers like Procter & Gamble are ideal examples here. This video series covers financial accounting. Manufacturers will be covered in a later course and a much later video, so you can forget about them for now. Lastly, and most pertinent to our next few videos, we have merchandisers. Merchandisers purchase finished products and then resell them. Examples here include auto parts, sporting goods, electronics, and department stores. If you imagine the creation of a commodity like exercise gear or smartphones, it begins with a manufacturer who then sells it to a wholesaler. Wholesalers are companies that buy in bulk and then implement a logistics chain to deliver the products to their customers, commonly retailers. Retailers then sell the product to you, the end consumer. Wholesalers and retailers are the merchandisers because they are buying a finished product and then reselling it. Accounting for a merchandiser will obviously have some distinctions between doing so for a service company. Most notably, income will be calculated differently. Net income is still the difference between total revenues and total expenses, but the calculation for a merchandiser is more sequential. Here you see the steps for calculating net income for these two types of businesses. To put number to these two examples, if we have a service company and a merchandiser, each with $60,000 in net income, the service company just lists all revenues and all expenses and takes the difference. The merchandiser will show its net income as follows. First, we subtract cost of goods sold from revenues to yield gross profit. Cost of goods sold may sometimes be referred to as cost of merchandise sold, but these terms are interchangeable. As for what cost of goods sold actually is, it's how much the merchandise we sold cost us to acquire. This is an expense because we're consuming our merchandise inventory asset by selling it. Gross profit is how much money we have left after deducting the cost of what we sold to cover our remaining expenses. We subtract our remaining expenses, namely those associated with running the business, and we have net income. This is a high-level view of the process. I'll cover the topic in more detail a little later. We're also going to have some new accounts to deal with. Let's consider a new company, Ride and Fly Bicycles. First, we have merchandise inventory under assets. Merchandise inventory is a resource. We own and control it, and it provides us a benefit. Specifically, we can sell merchandise to make money. Our next new account is Estimated Returns Inventory. It's a given that of all the merchandise we sell, some of it will be returned. This account estimates that amount. Under our liabilities, we have Customer Refunds Payable, which estimates how much in refunds we'll pay our customers in the upcoming period for any returns they make. On the income statement side, we'll add sales of merchandise, or just sales for short, to our revenues. Fees earned is where we record our service revenue, but sales of merchandise is where we record revenue from selling physical products. We also have sales discounts. Don't worry about that one for now. We'll cover it in more depth in a couple of videos. Finally, our new expense is cost of goods sold. Sometimes this is called cost of merchandise sold. Cost of goods sold records the removal of merchandise inventory when we sell it. Imagine Ride and Fly Bicycles purchases $1,500 worth of mountain bikes for $1,500 with cash. Consider what's happening in terms of our accounting equation. We're acquiring merchandise inventory, which is a resource. R&F owns and controls what happens to those bicycles, and that ownership provides R&F an immediate and/or a future benefit. It can either rent them out now or sell them in the near future to earn revenue. Consequently, merchandise inventory is an asset which is increasing. We acquired this inventory by paying cash, so we'll have a decrease in our cash asset. The increase in our merchandise inventory asset will be a debit for $1,500, and the decrease in our cash asset will be a credit for the same amount. When you're dealing with credit purchases, you'll almost certainly encounter early payment discounts. These are discounts off the purchase price offered in exchange for paying sooner rather than later. If you've ever loaned anyone money, you know that the longer that debt is outstanding, the less likely you'll get it back. Encouraging customers to pay early helps prevent that account from becoming delinquent. When you look at the invoice for the purchase, you may see a box titled Credit Terms with something like the text in front of you. You'd read this as $210 net 30. This means that the purchaser gets a 2% discount off the gross purchase price if the payment is remitted within the first 10 days after the invoice date. Otherwise, the full amount is due within 30 days. What if R&F purchases $2,000 of merchandise inventory on account, with credit terms $210 net 30? Note that even if you don't see the phrase on account, the fact that this purchase has credit terms tells us it's a credit purchase. If the customer paid in cash immediately, the transaction would have no need for credit terms at all. We'll book our journal entry just as we did in the previous example. We'll debit merchandise inventory for the value of merchandise received, and we'll credit accounts payable for the amount we now owe our supplier. Under the gross method, the early payment discount has no impact on the purchase entry amounts. However, you may see it noted underneath the journal entry for a quick reference for when the payment is booked. If R&F pays off that balance within the next 10 days, it'll remove that liability with a debit to accounts payable for the amount owed and credit the cash dispersed as the payment. How much cash is being dispersed? Remember, we're not paying out the full $2,000. We're paying out that amount reduced by 2%, or $1,960. You could also determine this amount by multiplying the $2,000 gross price by 1 less the discount percent, or 98%. At this point, our journal entry is out of balance, and we must have the same totals of debits and credits. To which account should we book the required $40 credit? Answer: merchandise inventory. This credit to merchandise inventory reduces the merchandise's value to the amount we actually paid for it. If you're confused, think back to our cost principle, which said we want to record our assets and liabilities at their costs, since that number is the most objective one. Showing the T accounts here may help. As I often tell my students who are stumped by a problem, when in doubt, draw a T account. With our purchase, we recorded the merchandise inventory at $2,000, the initial purchase price for the corresponding credit to accounts payable. At this point, this is the impact on our T accounts. When we paid, we debited accounts payable off the books, and we credited cash for the amount dispersed. At this point, our merchandise inventory on the books is greater than the amount we ultimately paid for it. Hence, our need for the credit to merchandise inventory. Now, our merchandise inventory on the books aligns with how much we paid to acquire it. Let's consider another transaction. Imagine R&F purchases $1,500 of merchandise inventory on account. Credit terms 210 net 30. Our purchase is recorded just as we did before. Debit merchandise inventory and credit accounts payable for the gross purchase price. What's our entry if it takes R&F longer than the 10 days to pay off the amount owed? Easy. If we miss the discount period, we pay the full $1,500. Just debit accounts payable and credit cash for that amount. The missed discount is now irrelevant. Let's consider a partial payment. Imagine R&F purchases $1,600 of merchandise inventory on account. Credit terms 210 net 30. Same entry as in the previous examples. Debit merchandise inventory and credit accounts payable. Imagine that 5 days after the invoice date, R&F pays off $1,000 of the amount owed. Our debit and credit accounts remain the same. We'll still debit accounts payable and credit cash. What's our amount? Well, the amount we owe is conveyed by accounts payable. So if we're paying off $1,000, that's our debit to accounts payable. How much cash are we dispersing to satisfy this obligation? Since we're paying within the discount period, we don't need to pay the full $1,000. Instead, we reduce that amount by 2% to get our cash disbursement of $980. Once again, you could also multiply the $1,000 gross amount by 98%, or 1 less the discount percent, to arrive at the same result. That $20 reduction is our credit to merchandise inventory. Again, we're reducing our merchandise inventory's value on our books to the amount we paid for it. Subsequently, we're not able to pay off the remaining balance until after that 10-day window. So what do we record? Well, how much do we owe? we have our initial credit of $1,600. We debited accounts payable for $1,000, leaving us a balance of $600. The discount period has expired, so the amount we owe is the amount we pay. Debit accounts payable and credit cash for $600. At this point, we need to discuss how to handle shipping charges. When you're selling a physical good, it has to be delivered to the customer. Which party pays for the delivery impacts how it is recorded. Our two basic shipping terms are free on-board destination and free on-board shipping point. With FOB destination, the buyer doesn't legally own the merchandise until it arrives at his or her location. Since the seller still owns the merchandise when it's loaded on the truck, the seller has to pay for the delivery. Once it arrives at the customer's location, the buyer signs for the delivery, taking legal ownership at the same time he or she takes possession. When the selling company pays for the delivery, it records it as an expense. In other words, it'll debit something like delivery expense and credit cash. With FOB shipping point, the buyer legally owns the merchandise inventory as soon as it's loaded on the truck for delivery. Since the seller relinquishes ownership at the shipping point, the buyer has to pay for the truck driver to make the delivery. The buyer will record the shipping charges in the cost of the merchandise inventory, so it'll be a debit to merchandise inventory and ultimately a credit to cash. Remember that this aligns with our cost principle. The buyer is ultimately recording merchandise inventory on the books at the amount it had to pay for it. Just as the discount taken reduced merchandise inventory to the final cost, an additional charge, like shipping and handling, or sales tax, will increase the value at which we record merchandise inventory. A variation of FOB shipping point is prepaid freight. This scenario occurs when the buyer is responsible for paying for delivery, but can't, at least not immediately. Consequently, the seller will pay for the delivery, and the buyer will repay the seller for the purchase. The seller's initial journal entry includes the usual debit to accounts receivable and credit to sales revenue, as well as the debit to cost of goods sold and credit to merchandise inventory. As I previously described, the seller covers the initial cost of delivery. In other words, the seller is crediting out cash to the delivery company. The buyer will repay the seller since the buyer is supposed to cover shipping. This means that the seller has the right to receive that reimbursement from the buyer, which it records with a debit to accounts receivable. That's how you record prepaid freight. Credit cash out to the delivery company and debit accounts receivable for the amount now owed to you from the buyer. Conceptually, it's not unlike if a friend were to offer to take you to lunch, but upon finishing your meals, your friend discovers that he forgot his wallet. You'd pick up the check, and your friend would pay you back. As for the buyer's books, the buyer records the normal debit and credit to merchandise inventory and accounts payable, respectively, though the dollar amounts include the shipping reimbursements within them. So how do we incorporate those shipping and handling charges into the journal entries for purchases and payments? All you need to remember is that any early payment discount needs to exclude shipping and handling. As an example, If R&F Bicycles purchases $1,200 of merchandise inventory on account with $100 of shipping and handling charges, terms FOB shipping point. Know that ownership transfers once it goes on the truck. So F&R Bicycles must pay for the delivery. If you want to break the transaction into two entries, you certainly may. For the purchase, you'll debit merchandise inventory and credit accounts payable for $1,200. Then, debit and credit those exact same accounts for $100. If you want to book just one journal entry, that's fine too. Just debit merchandise inventory and credit accounts payable for $1,300. When we pay it off, we'll debit accounts payable and credit cash for $1,300, the amount owed. What if that $1,200 purchase had credit terms of 210 net 30? Book it the exact same way, but only apply the discount to the purchase price. So debit merchandise inventory and credit accounts payable for $1,200. Next, debit merchandise inventory and credit accounts payable for the $100 freight charge. If you like, you can condense these two journal entries into one. If we pay off the balance within those first 10 days, debit accounts payable and credit cash. Our debit to accounts payable will be the total of the balance we owe, or $1,300. However, we won't disperse that amount in cash because we're paying soon enough to get the discount. Here's where most people make a mistake. We don't reduce the $1,300 by 2% because the discount only applies to the purchase price. So multiply the $1,200 by 98%, then add $100 on top of it. That 2% discount of $1,200 is our credit to merchandise inventory. Just as we saw previously, we're reducing the value of our merchandise inventory on our books to the actual amount we paid to acquire it. What if we pay off the balance after the discount period has passed? This entry is easy. Since we don't have any discount to incorporate, the amount we pay equals the amount we owe. Debit accounts payable and credit cash for $1,300. Remember that these entries wouldn't change at all if the seller had prepaid the freight. As the buyer, we're still responsible for paying for the delivery. The fact that we're repaying the seller as opposed to paying UPS or FedEx is irrelevant. We're still paying. So we debit that cost into merchandise inventory. Any early payment discounts are based on the purchase amount alone. What if that $1,200 were purchased on account, FOB destination? Recall that with FOB destination, the seller is paying the shipping charges, so the buyer is not. Consequently, the buyer doesn't need to record anything for shipping and handling. Just debit merchandise inventory and credit accounts payable for the purchase. When the buyer pays off the amount owed, debit accounts payable and credit cash. If there were any early payment discounts attached to this transaction, we would account for them exactly as we did earlier in the lecture. Effectively, when shipping charges are FOB destination, the buyer just ignores the charges entirely. That concludes this video. Thank you very much for watching. please come back for the next one on recording sales transactions. If my videos are helping you and you want to return the favor, you can thumbs up this one, leave a comment, and so forth. If you really want to help, temporarily subscribe to my channel. Not forever, just for however long you're taking your course. Finally, share my videos with your fellow classmates and perhaps your professor. I'd like my videos to help as many students as possible, and I wouldn't mind getting some input from contemporaries. Thank you once again, and I'll see you in the next one.